The Social Security Administration will process your claim without warning you about the permanent reduction. They will ask if you understand your benefit will be lower. You will say yes, and that lower number stays with you for the rest of your life. Depending on the year you were born, that mistake costs between $100,000 and $144,000 over a 20-year retirement. Today, I am going to make sure you do not make it. 4 groups, 4 sets of rules. Find yours. The consequences are permanent. Group 1, born between 1943 and 1954. You are between 72 and 83 years old. You have been on Social Security for a while. Your full retirement age was 66. And at this point, most people in this group assume there is nothing left to check. That assumption is costing some of you real money every single month. The first thing people in this group need to look at is whether they are collecting the right benefit. A significant number of widows and widowers in this age range are collecting their own retirement benefit when they would receive more on their late spouse's record, or the reverse. The survivor benefit for a widow or widower can be up to 100% of what the deceased spouse was receiving. In many cases, that number is substantially higher than what the surviving spouse is receiving on their own record. The SSA does not automatically compare both figures and put you on the higher one. That is not how the system works. The system pays whatever you claimed. If you lost a spouse and have never specifically asked the SSA to pull both numbers and tell you which is higher, there is a meaningful chance you have been leaving money on the table for years. Potentially for many years, depending on when your spouse passed. Call the Social Security Administration at 1-800-772-1213. Ask them directly to pull your benefit under your own record and your survivor benefit under your spouse's record, and compare both figures. If the survivor benefit is higher, ask what steps are required to switch. That one call could add hundreds of dollars to your monthly check, permanently, for the rest of your life. The second issue for this group involves Medicare, specifically a surcharge most people in this group have never been told they can appeal. IRMAA, the Income-Related Monthly Adjustment Amount, is a surcharge added on top of your standard Medicare Part B premium for people whose income exceeds certain thresholds. The surcharge ranges from an additional $70 per month to nearly $500 per month, depending on your income level. If you are paying more than $185 per month for Medicare Part B right now, you may be paying an IRMAA surcharge. IRMAA is calculated based on your income from 2 years ago. If your income has dropped because you retired, sold a property, or experienced any major one-time income event, you may be paying a surcharge based on money you no longer have. The appeal form is SSA 44. Complete it, document your current income, and submit it. If approved, the surcharge is reduced or eliminated going forward. Every month you do not appeal is money you will not recover. If this group applies to you, subscribe now before we go further. SSA rules around survivor benefits, IRMAA surcharges, and benefit switching change regularly, and the SSA does not send personal updates when they do. The people subscribed here find out before the window closes. Group 2, born between 1955 and 1959. You are between 67 and 71 years old. This is the most critical group in 2026 because the rules are different for every single birth year in this range. Most people do not know their specific number, and the decisions being made right now by people in this group are permanent. Here is the full retirement age breakdown. If you were born in 1955, your full retirement age is 66 years and 2 months. Born in 1956, 66 years and 4 months. Born in 1957, 66 years and 6 months. Born in 1958, 66 years and 8 months. Born in 1959, 66 years and 10 months. That is your number, not 66, not 67, your specific month and year. Write it down. Why does this matter so much right now? Because people in this group are making, or have recently made, their claiming decision. And the difference between getting it right and getting it wrong is permanent. If you claimed at 62 with a full retirement age of 66 and 6 months, meaning you were born in 1957, your benefit was reduced by approximately 25.8%. That reduction stays with you for the rest of your life. On a monthly benefit of $2,000, that is $516 less every single month. Over 20 years, that is $123,000. The SSA did not remind you of this before you claimed. They processed the application. For people in this group who have not yet claimed, if you are past your full retirement age and have still not filed, every month you continue to delay earns you 2/3 of 1% more permanently. That compounds to roughly 8% per year. Between your full retirement age and age 70, you can accumulate between 24 and 32% more per month for the rest of your life, depending on your exact birth year. On a $2,000 benefit, that is potentially $640 more every single month. Forever. The SSA will not call to remind you this is happening while you wait. For people in this group who are currently working and collecting Social Security before reaching full retirement age, the earnings test applies in 2026. If you earn more than $23,400 in a year, the SSA withholds $1 for every $2 you earn above that limit. The withheld amount is not lost permanently. It is credited back to your record once you reach full retirement age, and your monthly benefit is recalculated upward. But if you do not know this rule, that withheld amount can feel like your check disappeared without explanation. Tease. Group 3 faces the steepest permanent reduction of any group on this list, 30%. And there is an option available to people in that group that almost nobody asks for, worth up to $12,000 in a single payment. That is next. Group 3, born between 1960 and 1965. You are between 61 and 66 years old. For everyone in this group, full retirement age is exactly 67. And right now, the most important thing for people in this group to understand is what claiming before 67 actually means in dollar terms, because the SSA will not lay it out this clearly before you sign. Claiming at 62 with a full retirement age of 67 reduces your monthly benefit by 30%. Permanently. On a monthly benefit of $2,000, that is $600 less every single month for the rest of your life. Over a 20-year retirement, that is $144,000 in cumulative losses compared to waiting until 67. The SSA will process your early claim. They will ask whether you understand your benefit will be reduced. You will say yes. The reduced amount becomes your permanent number. There is no reconsideration after the fact. There is no correction if you change your mind a year later. The number is locked when you sign. For people in this group at or past 67 who have not yet claimed, there is an option the SSA will not mention unless you ask. You can request up to 6 months of retroactive payments. The SSA pays you as if you applied 6 months earlier, as a lump sum with your first check. On a $2,000 benefit, that is $12,000, paid immediately. The trade-off is a slightly lower ongoing benefit since your start date moves back. The option exists, it is available now, and almost nobody asks because almost nobody knows. For people in this group who are still 5 or 6 years away from claiming, the single most important action is checking your earnings record now. Go to the SSA website, create a My Social Security account if you do not have one, and open your earnings statement. Compare the earnings listed for every year against your own records. One incorrect year, such as an employer who submitted the wrong payroll figure, a freelance year that was not properly reported, or a job whose records were never transferred, reduces your monthly benefit by approximately $100. $100 per month. Over a 20-year retirement, that is $24,000 from a single incorrect year. Most people have never looked at their earnings record. Most people will not look until they are about to claim. By then, the documentation from decades ago is far harder to locate. Subscribe before Group 4 because Group 4 has the most time to fix things and the most time to lose that window without realizing it. Group 4, born in 1966 or later. You are 60 or younger. You are not close to claiming Social Security yet, and that is exactly why what follows matters, because the window to correct certain things without losing money is still open, but it will not stay open forever. Your full retirement age is 67. Claiming at 62 means a 30% permanent reduction. Waiting until 70 means up to 24% more than your full benefit, permanently. Those numbers are fixed by law. What is not fixed yet is whether your earnings record accurately reflects what you actually earned across your career. The Social Security Administration has been recording your payroll data since your first job. That data came from your employers. Every year was another opportunity for something to go wrong. An employer who submitted incorrect numbers. A year of self-employment that was not properly reported. A period where records from a closed business were never transferred. Each error that goes uncorrected reduces your monthly benefit when you eventually claim by approximately $100 per missed or incorrect year. If you worked through the 1980s and 1990s, the era of manual payroll processing, before digital systems standardized the reporting process, there is a meaningful probability that your record has at least 1 year that does not accurately reflect what you earned. The fix is straightforward. It requires documentation, and documentation becomes significantly harder to locate the longer you wait. W-2 forms, old tax returns, payslips, letters. Between your full retirement age of 67 and age 70, delaying earns you 8% more per year, permanently. On a projected benefit of $2,000, waiting the full 3 years produces $2,480 per month. The additional $480 every month for the rest of your life. If you live past 82, Waiting until 70 pays more in total than claiming at 67. The SSA will not mention this. They process whatever you submit. If you were born between 1943 and 1954, check whether you are on the right benefit record. If you lost a spouse, call the SSA and ask them to compare both figures directly, and check whether IRMAA is adding a surcharge to your Medicare Part B that you can appeal using Form SSA 44. If you were born between 1955 and 1959, know your exact full retirement age down to the month. Understand the permanent dollar cost of claiming early. If you have not yet claimed and are past full retirement age, every additional month earns you more permanently. And if you are working while collecting before full retirement age, understand the earnings test and how the withheld amount gets credited back. If you were born between 1960 and 1965, understand what a 30% permanent reduction means on your specific projected benefit before you make any claiming decision. And if you are at or past 67 without having claimed, ask specifically about the retroactive lump sum option. It is worth up to $12,000, and almost nobody knows to ask. If you were born in 1966 or later, open your earnings record at the SSA website today. Check it year by year. Find the errors now while the documentation is still findable and the correction is still free. And understand the 8% annual return available between your full retirement age and 70 before you decide when to claim. Subscribe and share this with someone you know who is in one of these groups. The SSA will not send a personal explanation when the rules change. You just got one.